Today, I'll guide you through selecting financial record-keeping practices that fit your business and support confident decision-making. We'll look at the systems and tools that help organize financial information, track business activity, and manage records effectively. Just as importantly, we'll consider how strong record-keeping supports growth and contributes to a broader business plan. The goal is not simply to collect numbers, but to create a reliable financial foundation for managing the business with clarity and confidence. Financial record-keeping matters for more than simply organizing receipts. It supports legal compliance because tax authorities, lenders, and regulators require accurate records, and poor documentation can lead to penalties, audits, or legal liability. It also enables informed decisions. With current financial data, owners can spot trends, reduce unnecessary costs, and recognize growth opportunities early. Finally, organized and transparent records build investor confidence. They demonstrate credibility to lenders and investors, which can be essential when seeking funding. Reliable records turn financial information into protection, insight, and opportunity. Every business relies on three core financial records, each answering a different question. The income statement shows performance over a defined period by tracking revenue, expenses, and net profit. The balance sheet provides a snapshot at one specific point in time, showing what the business owns, owes, and the owner's equity. Finally, the cash flow statement follows money moving in and out of the business, which is essential for managing day-to-day operations. Together, these statements provide a practical view of profitability, financial position, and available cash. Choosing a record-keeping method starts with matching the system to the business, rather than choosing the most advanced tool available. The right fit depends on transaction volume, budget, and overall complexity. Start simple, but plan to scale as your needs grow. For startups, spreadsheets or free software, such as Wave, may be enough. Growing small and mid-sized businesses may benefit from QuickBooks or Xero. And when operations become more complex, outsourcing to a CPA firm can provide the expertise and structure needed to keep records accurate and manageable. This slide compares the two basic approaches to bookkeeping. Single entry records each transaction once, much like a checkbook register. It's simple and fast, making it suitable for low-volume sole proprietorships, but offers limited visibility, cannot produce a balance sheet, and makes errors or fraud harder to detect. Double entry records every transaction as both a debit and a credit, creating a more complete and reliable picture. It supports full financial statements, audits, and investor review, and is required for corporations and LLCs. Most accounting software handles this automatically. This slide compares three popular accounting software options, each suited to a different type of business. QuickBooks Online is the established choice for small businesses, with strong reporting, payroll integration, and broad accountant support. Wave stands out for its free core features, making it practical for freelancers and micro businesses that need invoicing, expense tracking, and basic reports. Xero is cloud-based and especially strong for collaboration, which makes it appealing to startups that want scalable tools and real-time reporting. The best fit depends on your business size, needs, and growth plans. This slide compares the two main accounting methods. With cash basis accounting, I record revenue when cash is received and expenses when cash is paid. Accrual accounting records revenue when it's earned and expenses when they're incurred, giving a different view of financial activity. Both methods track revenue and expenses, but the timing changes. The IRS requires businesses with more than $25 million in annual gross receipts to use accrual accounting. Choosing the right method early can help prevent costly restatements and directly affect tax liability. Good record keeping is less about catching up later and more about building consistent habits now. First, keep business and personal finances separate by using dedicated bank and credit accounts. That makes reconciliation simpler and gives you a clearer view of business activity. Next, record transactions as they happen. Capturing receipts immediately, including through a mobile app, reduces missing information and errors. Finally, reconcile your books with bank statements every month. Regular monthly reconciliation helps identify discrepancies early and keeps your financial records accurate. Record retention is governed by both federal and state requirements. So when there's uncertainty, keeping records longer is generally safer than discarding them too soon. Tax returns should be kept for at least 7 years, especially because the IRS may audit returns up to 6 years back when income is significantly understated. Bank statements typically require 5 to 7 years. Payroll records should be retained for 4 years under IRS guidance, or 3 years under DOL guidance. Contracts and leases last for the contract term plus 7 years, while receipts and invoices require 3 to 7 years. A strong business plan should treat record keeping as an operating system, not an afterthought. First, identify your legal structure, because an LLC, S-Corp, or sole proprietorship can involve different records and tax forms. Next, choose either cash or accrual accounting and document that decision in the financial section. Budget for the software or service you'll use from launch. Finally, establish a consistent review cadence. Enter transactions weekly, reconcile monthly, and conduct a quarterly financial review. Consistency is what turns records into useful business information. The key takeaways are straightforward. Match your method to your stage. Start lean but plan to scale. Stay consistent by recording transactions daily. Remain aware of retention, tax, and reporting requirements. And remember that accurate records do more than support compliance. They become a dashboard for smarter business decisions.